Here with Brian Beckwith today. He's the Senior Managing Director of GE Capital and Healthcare Financial Services. Brian, it's been a tough year for finance companies, there's no question about that. Other than the obvious issues with SunWest Management, how is GE Seniors Housing portfolio performing right now?
We have exceeded even our own expectations, which were pretty high at the beginning of the year. We've the bad deals, SunWest being one of them, didn't turn out to be as bad as we thought. So we've had a great result from a loss perspective, very minimal losses, almost zero. And we're working through some of our tougher accounts, and it's been a good result from that standpoint. So our portfolio has held up really well. I think we've seen a little stress that came from occupancy declines on assisted living and independent living. But LIBOR's helped out a little bit, and they've managed their costs well. So in general, every sector of our portfolio has done well, and the bad deals, which we knew were going to be challenges, have worked out a little better than we thought they would.
Well, so that must really help things in terms of senior management. If everything else in real estate has been kind of crashing, and senior housing is still performing that well, you must be looking pretty good.
It helps. I mean, it's certainly we've, as everybody has, I think, when you go through internal credit committees. Healthcare is a little bit hard to understand sometimes. There's a reimbursement component that can change with the stroke of a pen, and having kind of this type of history and this type of environment sets us out a little bit better than when comparing against our peers, even internally at GE. And that's half the job sometimes, is managing that internal process.
Right. And what types of loans are you looking at today in the seniors housing area?
I don't think we've changed a lot from what we normally do. So portfolios of properties, as little as 2 or 3, on occasion, but 3 and upwards, and both skilled and assisted living is really where we're seeing the activity. We'd like to see, all across the board, independent, assisted, skilled, but generally our normal transactions, 3 to 5 properties. It's a portfolio, it's cross collateralized, and we're somewhat indifferent as to what part of the industry, what sector. And we've actually had a little success with those this year.
Good. And because you're a big company, I mean, you've got your size, you've got your balance sheet, you got your industry expertise. Over the last several years, you were one of the few lenders, one of the go-to lenders for big portfolio loans. I'm talking $100 million,
right,
up to maybe $1 billion.
Yep.
When they come back, is that a business that you want to get back into?
It is. I think the days of doing $1 billion deal for us are
limited.
Yeah, it's going to be more difficult. We're thrilled with those, specifically 2 of the deals where we took really, really large holds, and that's Genesis and SeniorCare, and they're both performing really well. That there are issues that you deal with because those maturities will come due one day, and we're trying to work proactively, at the very least right now with Genesis, and I'm sure we will going forward, to try and manage that exposure, that do some things good for us and good for them. But certainly going forward, we expect, and GE expects, and specifically GE Capital, to continue to commit money and funds to this industry. So, $1 billion holds aren't out of the question. They're just going to be a little bit harder.
Right. And even though you do have a very good reputation in the large loan side, just in talking with some of the people at GE, I was surprised over the years that you actually did a lot of smaller, one-off property loans. Is that the activity you're seeing in 2009?
We're not as good at those. We're not really good at one-off property deals. So we're not doing as many of those, and really haven't done any this year. So we're not seeing a lot of,
even a $20 million one-off.
No,
really?
Quite honestly, that's probably worse. A $20 million one-off is probably worse than a $7 or $8 million one-off. We'll do small portfolios, but I think the one-off properties it's not our strong suit. So we're staying clear of those. We generally like the portfolios.
Are you seeing many of the large portfolios right now? I mean, there's not that much activity. But
there's not. There's a lot of talk about activity coming. In the fourth quarter, there's a portfolio here or there that may trade, and if that happens, we're doing our best to be involved.
You want to be at the table.
Yeah, but I think the transactions we've done this year have been with current borrowers who may be exercising a purchase option on 3 or 4 properties, or those types of transactions, right, where they're we're the likely go-to lender because they've got a relationship with us. We can cross it with a different portfolio and kind of put some new funds out the door with somebody that we know and trust already.
Gotcha. And when do you really think credit is going to start flowing back into this market in a meaningful way?
In a meaningful way, I think there's a couple of triggers. One, people have to feel a little bit more stable, and I think when the residential market comes back a little bit, or at least people feel that it's stabilized, you'll see some folks come back into the independent and assisted side. I think there's a little bit of a hangover with the healthcare reform things that are out there, and until you have some clarity, you probably won't see in a meaningful way people coming back. We're looking forward to it because I think there's been a lack of those big deals that we like to do. And when I say big, I'm 50 and above. 50, yeah. And I think when we finally get that, so you have to have some clarity on reform. I think you have to have a little bit of clarity on some of the residential real estate because it is driving a lot of what we see on the earlier, less highly acute.
And the new construction market has been, I mean, people say it's dead. There's actually, in regional spots there's some development going on. But as a lender, if you look out thinking in 2010, 11, and 12, there's going to be very little opening up. Doesn't that make you feel much more, you and your credit committee feel much more secure about the industry?
I think it's one of the strongest points from a senior lender's perspective. We've made that argument forever. So there's always been the demographic argument that here's the growth rate of the people who need it, and here's how much is out there. So you need more facilities, and I think it's more acute now because that exact dynamic that you described. So we're thrilled about that, and it's actually has a little bit more weight now, I think, when we talk about it, both internally and when we look at deals in the market.
No, I would imagine.
It's a strong point, I think.
And I think you said this morning you've already done $300 million of new debt, new financings this year, which I was actually pleasantly surprised.
Yeah.
I thought it would be a little bit lower than that. What do you think your full year will be, and do you have a budget for 2010?
We're working through the budget for 2010 now.
Right.
I can see, and we expect it to be more. I think we expect 2010 to be a more active year. I'm cautiously optimistic that we have 3 or 4 deals in the fourth quarter that would be new transactions where there's an opportunity to put some more money out. So you could see anywhere from, if none of those happen, sticking around where we are, all the way up to probably $500 million of new volume for the year. Mm-hmm. And if things continue down the path, I would expect a little more activity next year. So there's a little bit of a game that we're going through internally to figure out what that budget would look like. But
this kind of market, it's hard to budget anything.
It is. If you asked me at this time last year, I don't even know that I could have answered the question.
Right.
And I'm sure I would have been wrong.
And on the equity side, you guys did that large acquisition from Formation Capital,
right.
The partners of the least skilled nursing facilities. So, you bought the real estate, all the tenants were in place and had nice coverage. Are you still in the market to do any more deals like that?
We're not going to be doing equity, I think, next year.
No equity. Okay.
We're not. We'll do some strategic pieces to support the deals that we have, but I don't think for the fourth quarter and probably not for 2010 that we're going to be looking for big equity plays. So we're going to probably focus more on senior lending.
It's a senior lending.
Yep.
Okay, good. Well, good luck next year.
Thank you.
I hope you hit the $500 million target this year.
I do too.
Go next year.
Yep.
All right, thanks.
Thank you.